Let me begin with a harsh truth. Most people, not just some, will lose money in the next crisis, not because they lack intelligence, but because they are trapped in the same human cycle that has wrecked fortunes for centuries. They trust what's working today and ignore what won't work tomorrow. Most people think they're making rational decisions when investing. They're not. What they're really doing is reacting to the emotions of the moment, to the headlines, to what their neighbor is doing. And that's what makes the majority lose money, especially during critical inflection points in the market. The reason isn't lack of intelligence, it's human nature. It's deeply wired into us to avoid pain and chase pleasure. In the markets, this turns into a cycle of fear and greed that repeats itself over and over again, no matter how advanced our tools or how much information we think we have. When markets rise, confidence builds. The more prices go up, the more people believe they will continue to rise. They extrapolate recent results into the future. This is when greed quietly takes over, not in a reckless or obvious way, but in a convincing, self-justified way. People begin to feel safe. They start to believe the risks are gone or that this time is different. They put more money in, they take on more risk, they leverage, they chase returns. But what they don't realize is that this environment of optimism is precisely what sows the seeds of the downturn. As valuations get stretched and risks taking increases, the system becomes more fragile. But because it still feels good, because everyone around them is making money, they ignore the signs. Nobody wants to step away from the table when the party is in full swing. Then something changes. It might be a tightening of interest rates, a disappointing earnings season, a geopolitical shock, anything that shakes the belief system, and very quickly sentiment flips, greed evaporates, fear rushes in. Suddenly, the same people who were comfortable taking large risks now want to exit. But exits aren't smooth when everyone is trying to leave at once. That's when prices collapse. That's when people realize they didn't understand the risks. That's when the majority lose. This cycle isn't new. It has happened repeatedly throughout history, in every asset class, in every economy, in every generation. From the tulip mania to the dot-com bubble to the housing crash. The triggers are different, but the behavior is the same. People chase what's been working. They ignore what could go wrong. They buy high because they feel safe. They sell low because they panic. What makes this so destructive is that it's not just individual investors. Entire systems fall into this trap. Policymakers do it. Institutions do it. Businesses expand at the top and cut at the bottom. It's systemic, it's cyclical, and it's predictable, not in timing, but in behavior. The only way to protect yourself is to step outside of this cycle. That means thinking differently. It means accepting that you're susceptible to the same biases and emotional responses as everyone else. You have to create a process that reduces reliance on emotion and builds decisions around principles and probabilities, not stories and trends. Preparation beats prediction. If you wait until fear takes over to reduce risk, it's too late. And if you wait until confidence returns to invest, you'll miss the opportunity. The key is to position yourself with balance, not just financial balance, but emotional balance, so that your decisions are not hijacked by panic or euphoria. This is uncomfortable. It means sometimes you'll look wrong in the short term. When markets are booming and you're more cautious, you might look out of touch. But the point isn't to look right. It's to be right over time. And that requires the discipline to act independently of the crowd. People lose money in crises not because the crisis wasn't visible. Often, the warning signs were clear, but they didn't want to see them. It was easier to believe the good times would continue. It felt better, and that's the trap. The cycle of fear and greed doesn't just move markets, it moves people, and that's what causes real losses. If you want to survive and thrive, you must recognize this pattern in yourself and others, not once, constantly, because every cycle will test your ability to stay grounded. Your greatest advantage is not prediction, it's preparation, discipline, and the ability to remain calm when others are not. That's how you win, not just in the next crisis, but over a lifetime. Most people don't see the storm until it's already overhead. That's not because the signs weren't there, but because they were looking in the wrong places, or they chose to ignore what felt inconvenient. Beneath the surface of every economic boom are the cracks, the structural imbalances that quietly grow until they can no longer be ignored. These imbalances aren't loud. They don't show up in headlines until it's too late. They accumulate slowly, like pressure building behind a dam. Debt is one of the biggest. When interest rates are low and credit is cheap, borrowing feels harmless. Individuals borrow. Corporations borrow. Governments borrow, and for a while that debt fuels growth. But it's not real growth. It's borrowed from the future. What people don't see is that each dollar borrowed carries with it the expectation of future repayment, and the more you borrow, the more fragile the system becomes. At first, it's manageable, but over time, obligations pile up and cash flows begin to tighten. Eventually, the cost of servicing the debt grows faster than the income required to pay for it. And here's the danger. The very policies that helped create the growth, easy money, low rates stimulus, become ineffective once the debt burden reaches a certain point. That's when the options run out. Central banks, for instance, try to stimulate demand with lower rates, but when rates are already near zero, there's not much room left. Governments try to spend their way out, but with massive deficits already on the books, confidence begins to erode. The tools that once seemed powerful start to feel blunt. Another imbalance is inequality, particularly of wealth and opportunity. In periods of expansion, the gap between those who own assets and those who don't tends to widen. Asset prices rise, stocks, real estate, private equity, and those who hold them grow wealthier, but the majority living paycheck to paycheck don't benefit from these gains. They watch from the sidelines as the top gets richer and their own lives get harder. Over time, this breeds resentment, political polarization, and social unrest. It becomes not just an economic issue, but a structural one, because stability depends on cohesion, and cohesion erodes when systems feel rigged. There's also a global imbalance between the economic powers that rely on cooperation and those that are increasingly driven by competition. When the world is integrated, supply chains are efficient, capital flows freely, and costs stay low. But when geopolitics shift, when alliances break down, or when countries turn inward, that system fractures. Trade becomes weaponized, currency becomes a tool of influence, and suddenly the economic engine that was running smoothly hits friction. That friction raises costs, reduces trust, and introduces new kinds of risk that most portfolios aren't built for. All these imbalances, debt, inequality, geopolitical fragmentation, they don't cause a crisis by themselves, but they make the system brittle. They ensure that when a shock comes, whether it's inflation, war, technological disruption, or a loss of faith in institutions, the damage is far greater than it otherwise would have been. The system doesn't bend, it breaks. What makes this especially dangerous is that most people look backward to understand risk. They rely on recent history to guide their expectations, but structural imbalances are forward-looking problems. They don't show up clearly on a balance sheet. They require perspective. They require the ability to see linkages, to think in systems, to step back and understand how everything connects. And that's something most investors, and even most policymakers, fail to do consistently. Preparation requires more than hope. It requires stress testing your assumptions, asking uncomfortable questions, being willing to look wrong in the short term in order to be resilient over the long term. You have to build portfolios, policies, and plans that can withstand not just the most likely outcomes, but the full range of possibilities, especially the painful ones. Storms don't happen because of one raindrop. They happen because of the pressure that's been building silently for months, even years. And when the clouds finally open, those who didn't notice or chose not to pay the price, being ready means seeing what others ignore. It means understanding the forces below the surface, not just reacting to the noise above it. Because when the next storm hits and the fragile pieces start to fall, the people who understood the structure will be the ones who still stand. Most people operate reactively. They respond to what's in front of them, what they feel in the moment, or what others around them are doing. That's a dangerous way to navigate a world that's complex, uncertain, and constantly shifting. In investing, in economics, and in life, if your decisions are based on impulse or imitation, you're setting yourself up to be vulnerable, not just to external shocks, but to your own emotions. That's where having principles changes everything. Principles are timeless truths you can return to when the world gets noisy. They don't eliminate uncertainty, but they provide clarity in how to face it. Most people chase results. They look at what worked last quarter or what's trending now. But that's backward looking. If you want to thrive through different conditions, booms, busts, crises, you need something more solid than predictions or gut feelings. You need a framework that helps you think clearly and act consistently, especially when the pressure is highest. Good principles don't tell you exactly what's going to happen. They help you prepare for whatever might happen. That means thinking probabilistically, understanding that no single outcome is certain, but that you can position yourself in a way where you can do well across a range of outcomes. This is the opposite of betting everything on what feels right. It's about humility. It's about accepting that you won't always be right and that the goal is not to avoid being wrong, but to survive being wrong and keep compounding through time. Most people don't lose because they were wrong once. They lose because they don't have a system that allows them to recover. A principles-based approach builds that system. It's what separates reaction from reflection. It helps you step back and look at the full picture, how one part of the economy affects another, how markets respond not just to data but to expectations, how human nature tends to repeat itself in cycles. One of the most important principles is balance. Balance between offense and defense, between risk and safety, between conviction and flexibility. You don't put all your chips on one outcome, no matter how confident you feel. You diversify, not just to reduce risk, but to make sure that you can stay in the game even when something doesn't go your way. Because eventually, something won't. And when that happens, the people without balance get wiped out. Another principle is to always be learning. The world is too dynamic for fixed views. What works in one environment might fail in another, so your thinking needs to evolve. That's not the same as chasing trends. It's about upgrading your understanding as new data comes in, without abandoning what's essential. A good principle doesn't change with the weather, but it can guide you through storms you've never seen before. Most people trust the crowd. They want confirmation from others before they act, but principles help you build confidence from within. That's critical when everyone else is panicking. When markets crash, when the news is negative, when fear is in the air, that's when principles matter most. They give you something to hold onto that's stronger than emotion. They keep you grounded when the world is shaking. A principles-based perspective doesn't promise smooth sailing, but it does give you the tools to navigate rough waters. It teaches you to think in systems, to zoom out, to recognize patterns and linkages, and it reminds you that success isn't about avoiding pain, it's about learning from it. Every mistake becomes a lesson. Every setback becomes a source of insight. Over time, that creates a powerful edge, not because you're smarter, but because you're more consistent. In the end, the most successful people aren't the ones who had perfect timing or perfect knowledge. They're the ones who built a solid foundation, one decision, one principle at a time. When the world changes, they adapt without losing direction. When others are caught off guard, they're already positioned for what's next. That's the power of living by principles. It's not flashy, it's not easy, but it works. And in a world where most people are led by emotion, the few who are guided by clear, tested thinking will always stand apart. Momentum is seductive when something is working, when markets are rising, when prices are climbing, when others are making money. It's incredibly easy to believe it will keep going. That belief is comforting. It feels rational. After all, if it's worked so far, why wouldn't it keep working? But that mindset is where most people go wrong. It leads them to chase what has already happened, to extrapolate the recent past into the future, and to trust blindly in a trend without understanding the underlying mechanics. The danger of momentum isn't just in the trend itself, it's in the misplaced confidence it creates. People begin to confuse rising prices with rising value. They stop asking why something is going up and start assuming that up is the new normal. They rely less on analysis and more on confirmation. They look to others to justify their beliefs. And when enough people are thinking the same way, it creates the illusion of safety. But in reality, that herd behavior amplifies fragility. It builds towers on weak foundations. Most people get in too late. By the time the masses recognize a trend, it's already mature. The big gains are gone, and what's left is exposure to downside. But it doesn't feel that way, because everyone's talking about how well things are going. The narrative becomes self-reinforcing. Media, social networks, even financial analysts start echoing the same optimism. And just like that, risk gets ignored, valuations get stretched, leverage increases. People feel smart for doing what everyone else is doing. This is how bubbles form, not just in markets, but in minds. A kind of psychological leverage builds up. And when that optimism is finally challenged, when a data point disappoints, or interest rates rise, or a shock hits the system, the unwind is brutal. Because when people are positioned for perfection, it doesn't take a disaster to cause a collapse. It only takes reality being slightly worse than expectations. Momentum traders tend to believe they can exit before the fall. They assume they'll see the signs in time, but history shows otherwise. The speed at which momentum reverses is almost always faster than people expect. Liquidity dries up. Exits get crowded. The same psychology that drove people in now drives them out, only in panic instead of greed. What was once a smooth ride up becomes a free fall. None of this is new. These cycles have played out repeatedly in tech stocks, in housing, in crypto, in commodities. It's not the asset that's the problem. It's the behavior around the asset. It's the overconfidence that comes from trusting momentum instead of fundamentals. The belief that what's working now will keep working simply because it has. That belief leads people to abandon discipline, to stop questioning, to stop preparing. The irony is that momentum is real. It exists. It can be a powerful force temporarily, but it's not a strategy on its own. It's a phase within a larger cycle, and those who treat it as permanent end up paying the price. The smart approach isn't to deny momentum exists, but to understand its limits. Use it while it lasts, but don't build your entire future on it. Don't assume that what's popular is what's safe. Often, it's the opposite. When momentum dominates, fundamentals fade from view. But in the long run, fundamentals are what matter. Prices can drift from value for a while, but eventually they reconnect. Violently if they've drifted too far. That's when the illusion breaks. That's when people realize they were riding a wave they didn't understand. The lesson is simple but hard to live by. Don't let recent performance blind you to real risk. Don't mistake popularity for durability. Be skeptical when things feel too easy. Ask yourself whether you're thinking independently or whether you've been swept up in the current. It's okay to participate in a trend, but always know why you're in, and more importantly, when and how you'll get out. Success over time doesn't come from chasing what's working now. It comes from seeing the bigger picture, from understanding the full cycle, from having the humility to admit you don't know exactly when momentum will end, and the discipline to be ready for when it does. Most people don't prepare for the end of momentum because they don't believe it will come, but it always does, and those who see it for what it is, not a solution, but a stage, are the ones who stay standing when the music stops. Being early feels like being wrong. That's the uncomfortable truth most people can't tolerate. They need validation, and they want it now. But in a world that moves in cycles and shifts gradually before suddenly, the greatest advantage is often the willingness to act before the crowd sees what's coming, even if it means sitting in discomfort while the world still looks the other way. The pain of being early isn't just psychological, it's practical. You might allocate capital into defensive assets while markets are booming. You might reduce risk while others are still celebrating record highs. You might speak about looming instability while the headlines are full of optimism, and in the short term it can feel lonely. Worse, it can feel costly. Your decisions might underperform. You might look overly cautious. People might question your judgment, but this is the cost of seeing clearly before others do, and it's a cost most aren't willing to pay. There's a reason why so many investors act late. It's easier. When the signs of trouble are obvious, it feels safer to shift your position. But by then, it's often too late. Prices have already moved. Volatility has already spiked. Liquidity is drying up. The window to prepare quietly and strategically has already closed. Acting early requires making decisions without applause. It means making moves that others don't yet understand. That's what makes it difficult. It challenges the ego. It tests patience. It forces you to hold conviction without reinforcement. In the short term, it often looks like underperformance. But the real question isn't whether you look smart today. It's whether you'll survive and thrive when the tide turns. The problem is that most people mistake recent calm for long-term safety. When nothing is going wrong, they assume nothing will go wrong. They become complacent, and when something eventually does go wrong, which it always does, they're caught off guard. But the ones who prepared, who took precautions, who accepted the short-term discomfort of being early, they're ready. They've built resilience into their systems. They can absorb the shock while others scramble. Being early is about seeing the bigger picture. It's about understanding the cycles, economic, financial, emotional, and knowing that by the time most people react, the opportunity has already shifted. It's about making asymmetric decisions where the potential downside of being early is far smaller than the cost of being late. That's how long-term success is built, not through constant accuracy, but through positioning that protects you when things break. But to do that, you have to detach from the need for constant feedback. Markets won't tell you you're right until much later. Friends, peers, media, they'll likely question your timing. The temptation will always be to wait, to follow, to conform. But that's how most people operate, and most people lose when the environment changes. If you want different results, you have to think differently and act before it feels good to do so. This doesn't mean being alarmist or reactive. It means being thoughtful, observing the underlying conditions, not just the outcomes, stress testing your assumptions, asking hard questions, and being willing to endure the discomfort that comes with positioning early. Because discomfort today is the price you pay for resilience tomorrow. The irony is that people often wait until it's too late to make changes, and then they overcorrect. They go from ignoring risk to panicking about it. They sell at the bottom. They retreat from markets completely. But if you've already positioned yourself early, you don't need to react emotionally. You've already accepted the pain of preparation, so you don't suffer the pain of reaction. What separates those who endure crises from those who are broken by them isn't prediction, it's preparation, and preparation is always early. You don't build a lifeboat in the middle of a storm. You build it when the skies are still clear. That way, when the waves hit, you don't panic, you navigate. The willingness to embrace the pain of being early is what allows you to remain calm when others are fearful. It's what gives you the flexibility to act when others are frozen. Over time, it creates a kind of quiet confidence, not because you know exactly what will happen, but because you've built a process that doesn't rely on certainty. Most people want to be comfortable all the time. But real security doesn't come from comfort. It comes from discipline, perspective, and the courage to act when the crowd is still asleep. That's not easy, it never will be, but it's what separates those who merely ride the cycle from those who rise above it. So here's the challenge. Will you repeat the mistakes of the past, or will you step back, think from first principles, and build resilient systems that survive and thrive amid chaos when the next crisis arrives? And most people will lose. But those who planned, diversified, and anchored their decisions in timeless principles, those are the ones who will not only preserve their wealth, they'll come out stronger. The question isn't if the next crisis comes, it's when and whether you're ready. Act today so that when tomorrow erodes hope, you stand firm. Thank you.